What's up everybody? Gen X Dividend Investor here. In this video I'm going to highlight one of the reasons why I love dividend investing so much, which is that even though the market has been falling recently, my dividend income continues to trend up. So if you appreciate stuff like this, then please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. And if your first thought you had after reading the title of this video was too live crew, then leave me a comment down below. Now, my original intent for this video was to focus on dividend income, but I'll also mention that my main dividend portfolio is still green year to date as of May 1st, which is when I started working on this video. That's pretty nice considering the S&P 500 is down around 14% year to date. I had a subscriber tell me that he was reading some comments on a YouTube channel that is about non-dividend stocks, and people were saying that their portfolios are down 50% year to date. 50%. A 50% drop is on its way to what I experienced in the dot-com crash or the 2008 financial crisis, so hopefully things don't keep dropping for them. Another subscriber of mine shared Cramer's Magnificent 7 stock picks from a year and a half ago. The caption says, "I've spotted 7 stocks where investors don't care what they do, they just want to own the names," and he shows Netflix, PayPal, Peloton, Roku, Square aka Block, Tesla, and Zoom. I put all Cramer's stock picks into a spreadsheet to see how they've done since he made that video, as well as to see how they've done year to date. So on the left side is how they've done in the last year and a half, and we see that all of them are red other than Tesla, and that overall they're down about 40% since his video. On the right side is how they've done year to date, and we see that since January 1st they've fallen about 49%. Ouch. Of course, keep in mind that long-term investors should be intending to invest for decades, and thus shouldn't fixate on how they've done over short periods of time. But the kind of market we're in explains part of the reason why I love dividend investing. The market falls, but my dividend income keeps flowing in like clockwork. I'd personally hate to be someone who is operating under the stressful 4% rule and be forced to sell when markets are going down. Or be sitting there wondering if you're going to outlive your portfolio. No thanks. Us dividend investors just keep collecting the golden goose's eggs. Our goose is our pet, and we don't eat our pets. We're just average investors looking to find ways to get low-stress passive income. That being said, there is a lot of data out there showing how the average investor underperforms the markets. Here's data from a recent Fidelity report looking at average investor returns from 2000 to 2019, and we see that investors only made 4.25% per year. Here's a different report that shows that the average investor from 1995 to 2014 only made 2.5% annualized. And why do average investors underperform? Well, it has to do with human behavior, from loss aversion to overreaction to headlines to narrow framing. If you'd like me to do an entire video on the behaviors that lead to poor investing performance, then leave me a note in the comments. Now, I want to be clear that dividends aren't a guaranteed way to make a return, and they aren't infallible. Nothing in life is guaranteed. Well, I mean, other than death and taxes maybe. And just because a company has done great in the past doesn't mean they're guaranteed to do great in the future. But if you're going to invest, then going with long-lasting companies who have rich histories of performance seems like a reasonable place to start your due diligence. So while my dividends aren't guaranteed, they seem like a pretty good bet overall. Dividends often come from durable, long-lasting companies, which helps explain why non-dividend growth stocks often get hammered more than conservative blue-chip dividend stocks during times of market fear. What happens is investors move into safer stocks as times get tough, stocks that have survived for decades and weathered the storm. Like, consider Kimberly-Clark. Do you think that people will keep spending money buying Scott toilet paper or Kleenex tissues or Huggies diapers or whatever? I think so, and they'll continue to do so pretty much regardless of what happens in the world. I'm long Kimberly-Clark and I'm proud that they just became a dividend king this year when they increased their dividend again. Customers love their products. The same is true for Procter & Gamble's Bounty paper towels, or their Tide laundry detergent, or their Gillette Mach 3 razors, or whatever. Investors know that customers around the world will keep buying those types of staples products, which means those businesses will keep making money, which also means they should keep paying out dividends to their shareholders like me. But a company like Peloton, which has a really cool innovative product, isn't one that you have to have. I mean, exercise is important, but in hard financial times, people are more likely to cancel a recurring monthly Peloton subscription to save on expenses than they are to stop doing laundry or using toilet paper or whatever. Investors in all stocks want to see growth, but especially in non-dividend stocks. When things get shaky, people flee. Look at Netflix. They got slammed because they didn't grow enough, because their competitors are delivering good streaming platforms. So why hold a stock if it's not growing enough? Non-dividend stocks are a lot more stressful to own in markets like these. But especially dividend investors don't worry about stock prices falling in the short term. Our dividend checks keep flowing in, and we know that people will keep going to places like McDonald's in good times and in bad times. But not only do dividends keep coming in, but in these turbulent markets I've been getting a bunch of dividend hikes. Listen to some of the increases I've gotten just this year. Apple increased 4.5%, Southern Company 3%, Travelers 5.7%, J&J 6.6%, Procter & Gamble 5%, Colgate-Palmolive 4.4%, Home Depot 15%, Coca-Cola 5%, Pepsi 7%, Chevron 6%, and then BTI, 3M, Kimberly-Clark, and Realty Income all did small token increases. Now, AT&T lowered their dividends since they spun off their Warner Brothers division, but they also gave us a monstrous special dividend to compensate. I mean, the dividend they paid out for the spinoff was like 5 years of tax-free dividend payments all at once. And when I think about it, 5 years of dividends paid out, tax-free, all at once, right now, is worth maybe 7 years of potential future dividend payments. And they still have a dividend yield which puts them amongst the biggest payers of the S&P 500, with theoretically way less debt and faster EPS growth potential than before. So while it's technically a cut, it was the biggest dividend I've ever received. Now sure, this year's dividend hikes have been eaten up by inflation, but my recommendation is not to overly fixate on 1 year of inflation data. My dividend hikes have historically beaten inflation for decades, so a year or two where inflation does better doesn't bother me. Don't tunnel vision on a single financial metric or stock or time frame or whatever. Always play the long game. Look at longer term trends. And don't try to time the markets. Most people who try it lose, which is another reason why the average investor underperforms. So be wary of YouTube channels where they preach buy and hold investing, but then they panic out of the market. Clearly they were preaching something they didn't believe, probably because they were new to the stock market. It's terrible advice over the long term. The best investors in the world, and Buffett and Munger, don't do it for a reason. Here's some clips from the 2022 Berkshire Hathaway annual meeting regarding how Buffett and Munger don't time the markets or the economy, which I encourage you to listen to.
My question is, how do you time the big market moves so well?
The interesting thing is, obviously, we haven't the faintest idea what the stock market is going to do when it opens on Monday. We never have had. We have never made, Charlie and I don't think, in all the time we've worked together, and we have never, I don't think we've ever made a decision that where either one of us has either said or been thinking we should buy or sell based on what the market is going to do.
No.
Or for that matter, on what the economy is going to do. We don't know. We have not been good at timing. We have been reasonably good at figuring out when we were getting enough for our money. And we had no idea when we bought anything. Well, we always hoped it would go down for a while so we could buy more, and we hoped even after we were done buying and ran out of money that if it was cheap, the company would keep buying, in effect taking our interest up. I mean, we haven't ever timed anything. We've never figured out insights into the economy.
So don't try to time the markets, just stay invested. Now, there are experts who say you should sell everything and sit in cash. Even a broken clock is right twice a day. What I mean is some people always push fear and tell people to move into gold or cash. Those people are usually wrong for a decade and then correct and then wrong for another decade. Fortunately, my strategy, at least so far, has allowed me to just keep acquiring good assets and not worry if the stock market crashes. And regardless of what happens, don't freak out if you bought a good stock and it's not performing up to your expectations. Hopefully you have a diverse portfolio of stocks, and some will inevitably be winners and some will be losers. It's okay to be down on a stock, but make sure you understand why. It surprised me how many investors don't understand the basics about stocks or dividends. Case in point, there was a troll on Twitter who started responding to my tweets but was drawing inaccurate conclusions. I'll hide his name to keep him incognito, but one of his tweets about dividend investors said that they are too new to investing to have lived through a true bear market. They will feel the pain at some point. Dividends do not protect in a bear market. Watch, you'll see what I'm saying. You gotta love trolls. Well, Trolley, let's define what a bear market is, and then use data and facts to see if you know what you're talking about. Investopedia says that markets are in bear territory when stocks, on average, fall at least 20% off their high. Well, I'm a dividend investor who's been investing for over 25 years and have invested through the recent pandemic crash, through the great financial crisis that started in 2007, and through the dot-com crash which started in 2000. So Trolley was incorrect on pretty much every point he made in his first sentence. Then he went on to say dividends do not protect you in a bear market. The reality is that dividends from quality companies have protected people for decades. Like almost all of my stocks have continued to pay out and even increased their payouts during every bear market I've been in for over 2 decades. The reason I became so passionate about dividend investing was precisely because of my experience in the dot-com crash as well as in the global financial crisis crash. It was amazing to see my dividend stocks lose less than my speculative tech stocks, and it was even more amazing to see my dividend companies to not only keep paying their dividend but also to increase them. So Trolley was wrong on pretty much everything he said. In fact, I'm confident enough in my dividends protecting me that I quit my job and now rely on dividend income to pay my bills. No dividends, no paying my mortgage or healthcare or groceries or whatever. Trolley lacks basic knowledge about good dividend companies, or he would have known that dividend kings have paid out and increased their dividend for 50 plus years and aristocrats have for 25 plus. So will some dividend companies fail? Sure, but the majority of good ones succeed. Regardless, I hope Trolley succeeds in whatever path he ends up on. I'm happy with my investing strategies, and I'm ecstatic that my dividend income just hit a new all-time high at $91,560 a year in dividends, which is about $118,000 a year in Canadian dollars. I have a bunch of Canadian viewers, so I gotta show them some love now and then. To this day, it still blows my mind that dozens of companies pay me consistent passive income for doing nothing. Yes, I worked my butt off and took the risks to invest in them, but now the payoff is incredible. And I don't need to do anything for that passive income to flow in. I don't need to stress about trying to constantly buy and sell. I don't need to deal with customers and their issues. I don't worry about falling markets. I just keep collecting my dividends and I'm grateful I'm a dividend investor. Now, a common question people ask is if the overall market is still too expensive given how much it's fallen. Well, according to historical data, the S&P 500 average PE was about a 13 between 1900 and 1980, and then the average PE increased to about 22 from 1981 to 2020. So while the overall average market PE over history is around a 15, some people argue that a 20 PE like we've had in the last 40 years might be a new normal given that technology has enabled a higher multiple, along with due to depressed interest rates. Low interest rates drive equity risk premium on stocks as well as give asset markets tons of cheap money which stocks love. But inflation eats away at PE. When inflation rises, it means prices in the economy are rising, leading investors to require a higher rate of return to maintain their purchasing power. And if investors demand a higher rate of return, the PE ratio falls. When we have inflation, the price of everything that you buy increases, and it occurs when the government prints more money than the value of goods in the economy, and the result is that prices go up to reflect the loss of money value. Interest rates can help against the loss of value. So interest rates go up as inflation goes up, which applies downward pressure on stocks and PEs. Interest rates go down as inflation goes down, and then stocks tend to go up as do PEs. Of course, nothing is that simple, because when inflation turns to deflation, then PEs tend to go down. The lower the PEs, the more buyers start coming in since things are cheaper. Anyways, what kind of market PE do we have today? Well, the Wall Street Journal said that the average PE of the S&P 500 is at a 24 as of Friday the 29th of April. So 24 is a bit higher than normal, but that's way better than it was a year ago at 40. There's a lot of fear in the markets right now, and I have no idea where things will go in the short term, but I'm a long-term bull. Us dividend investors are happy in all markets. In down markets, our snowball is growing faster and we're getting cash flow, so we're happy. In sideways markets, our snowballs are growing faster and we're getting cash flow, so we're happy. And in up markets, our portfolio is growing and we're getting cash flow, so we're happy. Win, win, win. Okay, now I'd like to shout out my latest Patreon aristocrats who have signed up since my last video. So thank you, Smart. Thank you, Chris D. Thank you, Ty Stephen Hilldog for signing back up. Thank you, Pierre from channel PK Investing, who just upgraded to be a Patreon aristocrat for a full year. That gives him a 10% discount versus the month-to-month amount. I'll include a link to his channel in the description of this video, so please go subscribe. He does videos on dividend investing amongst other things. And thank you, Smoky Sky, who also upgraded to a full year Patreon aristocrat. There are limited spots remaining, so sign up now if you're interested. Aristocrats gain access to my dividend portfolio tracker spreadsheet, which I use in lots of my videos, and they get special access to various private channels on my dividend Discord, including one which lets you watch my videos before I release them publicly on YouTube, as well as lets you vote on which thumbnails I should use. Finally, I want to thank Vision 360 Fire Financials, who just upgraded from a month-to-month Patreon aristocrat to a full-year Patreon king. I'll include a link to his channel in the description of this video, so please show him some love and subscribe. Kings get everything aristocrats get, and they get to have a 30-minute private one-on-one voice chat with me each month. Finally, I urge everyone to join my free Dividend Discord chat server, which has thousands of dividend investors on it from around the world. Please hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.